You have learned 5 option strategies over the past 5 videos. Covered call, cash secured put, the wheel, protective put, and bull call spread. Each one is a precision instrument designed for a specific market condition, a specific position type, a specific risk profile. But knowing how each strategy works is only half the job. The other half is knowing which one to deploy and when. Picking the wrong strategy in the wrong conditions is as costly as picking no strategy at all. High implied volatility is the environment where you sell premium, not buy it. Binary events demand defined risk positions, not open-ended ones. This final video gives you the decision framework for questions that map any market condition to the right strategy. By the end, you will be able to sit down at any options chain in any market environment and know exactly which tool to reach for and why. The framework reduces every options decision to 4 questions. Question 1. Do you currently own the underlying shares? Your answer determines which strategies are available to you. Covered calls require you to own shares, cash-secured puts, and spreads do not. Question 2. What is your market outlook for the next 30 to 60 days? Bullish, neutral, or bearish? This eliminates strategies that require the wrong direction. Question 3. What is the current implied volatility environment? High 4 rank means options are expensive, selling premium is favorable. Low 4 rank means options are cheap, buying premium is favorable. Question 4. What is your risk tolerance? Defined risk strategies cap both profit and loss. Unlimited upside strategies carry uncapped downside. Ask these 4 questions in order and you will arrive at the right strategy every time, without guessing, without overthinking. Here is the full strategy map, 5 strategies positioned by market condition and position type. On the horizontal axis, your market outlook, from bearish on the left to bullish on the right. On the vertical axis, whether you own shares or not. Top left, you own shares, bearish, protective put. Top center, you own shares, neutral, covered call. Bottom center, no shares, neutral, cash secured put. Bottom right, no shares, bullish, bull call spread. Spanning both center positions. The wheel, the systematic combination of cash secured put and covered call, rotating between them as conditions move from neutral to slightly bullish. Implied volatility overlays the entire map. When 4 rank is high, lean toward the premium selling strategies. Covered call, CSP, wheel. When 4 rank is low, lean toward the premium buying strategies. Protective put, bull call spread. This map is your permanent reference. The first question is the most fundamental. Do you currently own 100 shares of the underlying? If yes, your primary strategies are the covered call and the protective put. The covered call turns your existing position into an income engine. You sell calls against your shares each cycle and collect premium. The protective put turns your existing position into a defined risk vehicle. You buy a put to cap your downside before a known risk event. If you do not own shares, your strategies are the cash-secured put, the wheel, and the bull call spread. The cash-secured put gets you paid while waiting to buy at your target price. The wheel begins with a CSP and continues as covered calls once assigned. The bull call spread gives you directional exposure without needing to own the stock. Stock ownership is the first fork in the decision tree. Answer it correctly, and you immediately eliminate half the strategy options. The second question is your directional view. Moderately bullish. You expect the stock to rise slowly or stay flat. The covered call, cash-secured put, and the wheel all profit in this environment. They are income strategies, not directional bets. They collect premium whether the stock rises modestly or barely moves. Strongly bullish. You expect a significant move higher within your time frame. This is where the bull call spread earns maximum profit. The ramp between the 2 strikes is designed for exactly this, a defined, targeted directional move. Neutral. You expect the stock to go sideways for the next 30 to 60 days. Covered call and cash secured put are ideal. You collect premium. The stock does not move, and theta decay works in your favor. Bearish, with a binary event approaching. This is where the protective put belongs. You are not abandoning your position. You are defining its floor while you wait out the event. Implied volatility is the options market's pricing mechanism. When 4 rank is above 50%, options are expensive relative to their historical range. Selling premium in this environment means you are collecting more than the statistical average. Covered calls, cash-secured puts, and the will perform best here. You are the insurance company when 4 is elevated. You collect outsized premium and wait for volatility to mean revert. When 4 rank is below 30%, options are cheap. Selling premium here means collecting less than the norm. This is when buying premium becomes attractive. The protective put costs less when 4 is low, reducing the cost of insurance. The bull call spread benefits from low 4 environments. The debit paid is smaller and the break-even is closer to the current price. Read 4 rank before placing any trade. It is the single most important contextual input after direction, and most retail traders ignore it entirely. Deploy the covered call when you own 100 shares of a stock you are comfortable holding or selling at the strike price. Your outlook is neutral to slightly bullish for the next 30 to 45 days. For rank is above 40%. Premium is elevated and you collect more per contract. You are in the 30 to 45 day expiry window for maximum theta decay. Avoid the covered call when you are strongly bullish and a large move would cap significant gains above the strike. Earnings are imminent within the expiry window, for crush post-report can produce an unexpected gap through your strike. You are not willing to sell your shares at the strike price if called away. The covered call is an income tool, not a directional tool. Use it to extract yield from a position you already own during low movement periods. Expect to repeat it monthly on the same underlying as part of a systematic income rotation. Deploy the cash-secured put when you want to own the underlying stock at a lower price than the current market and you are happy to buy at the strike. Your outlook is neutral to bullish. You are fundamentally comfortable taking assignment. For rank is above 40% and the premium collected justifies the obligation. You have the full cash reserve to purchase the shares, no leverage. Avoid the cash-secured put when the stock has a binary event within the expiry window. Earnings, FDA decision, regulatory ruling. A gap down past your strike can leave you holding a large loss that the premium does not cover. Also avoid when 4 rank is low and the premium does not justify the risk. The cash-secured put works best on large, liquid, fundamentally sound underlyings, SPY, QQQ, APL, MSFD, where assignment is manageable and the stock has deep structural support. It is a patient income strategy, not a speculation tool. Deploy the wheel when you want systematic, recurring income on a stock you are fundamentally comfortable owning for the long term. Phase 1. Sell cash-secured puts below the current price. Collect premium. If not assigned, roll to the next expiry and repeat. If assigned, you own the stock at your cost basis minus all premiums collected. Phase 2. Sell covered calls above your cost basis. Collect premium. If called away at the strike, you have sold the stock at a profit above what you paid. If not called away, repeat covered calls on the same position. The wheel has no defined end date. It runs until you choose to stop or the stock moves structurally against you. Use the wheel on high liquidity, fundamentally sound stocks, and ETFs. Avoid using it on speculative, high volatility names where a gap down during the CSP phase creates a large loss that years of premium income cannot recover. The edge is that options premium is statistically overpriced. You are consistently on the right side of that. Deploy the protective put when you own shares with significant unrealized gains and a known binary event is approaching. Earnings, central bank decisions, product launches, clinical trial results, any event where the stock could gap down 20% overnight. Your concern is not the long-term direction, but the short-term downside in the event window. You want to stay invested, but define the floor. 4 timing matters. Buy the protective put before the 4 spike, not after. 4 rises as events approach. Your put becomes more expensive the longer you wait. Buy 4 to 6 weeks before the event when 4 is still moderate. Avoid the protective put when there is no specific risk event. A perpetual put is expensive and theta will destroy it. 4 is already elevated. You are overpaying for protection. If 4 is very high, consider a put spread instead. Sell a lower strike put to offset the cost of the higher strike put you buy. Protection at a lower net cost. Deploy the bull call spread when you are moderately bullish with a specific price target that falls within the spread width. You want directional exposure without committing to a full long call premium. 4 is moderate to elevated, and selling the upper strike reduces your entry cost meaningfully. Capital efficiency is a priority. Choose the spread width to match your target. If you expect a $10 move, use a $10 wide spread. Set the lower strike at or near the current price for maximum delta exposure. Set the upper strike at your price target. Avoid the bull call spread when 4 is very low. In this case, the single long call may be more cost-effective since the premium collected on the upper strike is minimal. You expect a large breakout far above the upper strike. The cap profit structure works against you on a large move. Earnings are imminent. The post-event 4 crush can destroy both legs simultaneously, eliminating the value of the spread regardless of direction. Here is the full decision tree, one path for any market condition. Start at the top. Question 1. Do you own shares? If yes, is there a binary risk event approaching? Yes. Deploy the protective put. No. With neutral to slightly bullish outlook and 4 rank above 40%, deploy the covered call. If no, you do not own shares. What is your outlook? Neutral to bullish, comfortable owning the stock, for rank above 40%, want systematic income, deploy the cash-secured put. Already assigned from a previous CSP, deploy the covered call on those shares. You are now running the wheel. Moderately bullish, defined risk directional bet, for moderate, deploy the bull call spread. This tree collapses 5 strategies into a single, repeatable decision process. Walk this tree before every options trade. If you cannot answer one of the 4 questions clearly, you do not have enough information. Wait until you can answer all 4 before placing the trade. Here is a live application of the framework. SPY at $510. For rank, 42%, elevated, a premium selling environment. You own 100 shares of SPY at a cost basis of $480. No earnings. SPY is an index with no binary event risk. Your outlook, neutral to slightly bullish for the next 45 days. Walk the decision tree. You own shares. No binary risk event. Neutral to slightly bullish. For rank above 40%. The answer, covered call. You sell the SPY 520 call, 45 days to expiry, for $4.50. $450 of income. If SPY stays below 520 at expiry, you keep the premium and repeat. If SPY rises above 520, you are called away at 520, a $40 gain per share on the position plus the $450 premium. Both outcomes are acceptable. This is the framework in practice. Systematic, repeatable, condition-matched. Here is the complete series in one view. Video 8. The covered call. Income from shares you own. Neutral to slightly bullish, for above 40%. Video 9. The cash-secured put. Income while waiting to buy at your target price. Neutral to bullish, for above 40%. Video 10. The wheel. Systematic income rotation between CSP and covered call on a stock you are comfortable owning. Video 11. The protective put. Insurance for shares before a binary event. Bought before the 4 spike. Video 12. The bull call spread. Defined risk directional bet, moderately bullish, capital efficient. Together, these 5 strategies cover 4 distinct market conditions: neutral income generation, bullish positioning, downside protection, and directional speculation, all with defined or manageable risk. You do not need 30 strategies. You need 5, deployed correctly, in the right conditions. The framework you now have tells you which one to use, when to use it, and when to stand aside and wait for better conditions. Here is what you now have, and what you can now do. You understand how options are priced, what the Greeks measure, and how to read an options chain. You can execute 5 core strategies across 4 distinct market conditions. You have a decision framework that maps any market environment to the right tool, without guessing, without emotional decisions. And you understand the one principle that separates consistent options traders from everyone else. Define your risk before the trade begins. Every strategy in this series has a known maximum loss at entry. That is not a coincidence. That is the foundation of a trading system. From here, practice each strategy in paper trading before committing capital. Start with the covered call and the cash-secured put, the lowest complexity, highest probability strategies in the toolkit. Track every trade. Review what the framework told you to do versus what you did. Close the gap between those two over time. That is how an edge is built. This is mathematical money. Stop guessing, start calculating.